Okay, so we start with statement of cash flow. We're saying the statement of cash flow is a reconciliation. It reconciles the profit that you've made in a period to see how this profit relates to the cash that you have made in the period, the cash balance which will be sitting in the statement of financial position in the current year. So you'll be moving from the profit and loss to the balance sheet. Okay, so we're moving from the profit that you've made. So you start with profit before tax. Then you want to end up at the cash balance in the statement of financial position in the current year. So the statement of financial position, you'll be given two periods, for last year and for this year. But the cash balance you want to arrive at is the one for this year. There are two methods of preparing the statement of cash flow. The first one is an indirect method. This is where the profit before tax is reconciled to operating cash flows. Then there's also the direct method, where the cash flows themselves, just the cash flows themselves are shown. But for exam purposes, the examiner has mostly tested the indirect method. So the standard IS 7, which regulates the statement of cash flows, splits the statement of cash flows into three main sections. The first one is cash flows from operating activities, followed by cash flows from investing activities, and finally cash flows from financing activities. So let's look at these individually. The cash flows from operating activities looks at those activities which have to do with operation of the business, the core functions of the business, what the business does on a daily basis, okay, its operations. So you start from the profit before tax. You check going upwards in between the gross profit and the profit before tax. That section there. You take out anything which has got nothing to do with operations. You move it out from that section. Now, how do we do it? You do opposite with what you do in the income statement. So if in the income statement you added, in the cash flow you're going to subtract. If in the income statement you subtracted, in the cash flow you're going to add. You just do the opposite. Okay? So take out anything which has got nothing to do with operations. Take out also anything which has got nothing to do with cash movement. Items like depreciation. Depreciation is a business expense which we subtract from profit and loss. Okay? But depreciation is not cash. So we eliminate that by adding it back to the profit. Items like finance costs. Finance costs have got nothing to do with operations, but those who bring them as business expenses in the operating section in the income statement. we eliminate those. Investment income also has got nothing to do with operations. We eliminate that. Once we are done with that group, the operating activity section, then we go to the working capital group. The working capital group, we pick it from the incomes, from the statement of financial position. This comprises of receivables, payables, and inventory. So you look at what has happened between the inventory from last year to this year. Has there been an increase? If there's been an increase in inventory, what does it mean? It means cash has gone out. You've bought more inventory than the inventory that you've sold. So the difference will be cash outflow you subtract. If the inventory levels are lower this year than last year, it means you've sold out more inventory than you've ordered. It means cash has come in. So the difference, again, you're going to add. Okay. The receivables, same thing. You look at the opening receivables and the closing receivables. If receivables have gone up, what does it mean? Does it mean cash has come in or cash has gone out?
Receivables have gone up.
If receivables have gone up from last year, has cash come in or has cash gone out?
Cash has gone out.
Cash has gone out because you've given out goods on credit, you have not received the cash. So you're going to subtract. Vice versa, if receivables have gone down, it means you've collected more than you have given out on credit. What of payables? If payables have gone down, has cash gone out or has cash coming?
Cash has gone out.
Cash has gone out because you've paid out more than what you've borrowed in terms of goods. Okay? So when you're done with that group, that's when you come to, you close that, then you come to the final part of the operating activities where you bring in your interest. That interest which you moved out from the operating activities, this is where you bring it. Okay. Now, the interest, before you bring that interest you took out under the operations, you need to check your statement of financial position. If there is any finance costs in the statement of financial position, then you have to do a working. That working will be to determine how much was the actual cash which has been paid out in terms of finance costs. So your working is computed as follows. You start with your opening balance. So you're going to have opening balance, then leave a space, bring your closing balance, which you're going to close off. Then to the opening balance, you're going to add the finance costs which is in the P&L. You add the two. Then the difference with your total in the closing balance, that will be the cash which has been paid out. That's what you bring in that group just immediately after the working capital group. But if there is no finance costs in the statement of financial position, then the same finance cost that you took out from the operations, you come and subtract it under the next group here. In this group, you also bring in your tax. Now, tax, most questions, almost all questions, tax, you'll be required to do a working. The working is the same: opening balance minus, no, you do an opening balance, then you leave a space, you bring your closing balance, which you close off. The opening balance, you go in the income statement. Remember, we started with cash flow before tax. Then you go to that tax, get that tax, add it to the opening balance tax, which you have picked up in the statement of financial position. Okay, get the total. The difference between the total and the closing balance tax in the statement of financial position, the difference is the actual cash tax that you've paid. Clear? When you're finished with that group, then you close and transfer your total to the far end column. Then you are done the cash flow from operating activities.